Hi learners, a warm welcome to FinBank Academy. This is my first video, so I want to give a brief introduction about my channel and myself. This channel helps to clear the exams like JIB, CIB, and other IIBF exams, and also enhance your banking knowledge. Myself, Yugandhar Sanjeevu, and I am the person who discuss various topics in this channel. And I have an experience of around 11 years in the banking sector. Okay, let's start our first video, that is basics of balance sheet. In this video, we will learn about various components of balance sheet and broader outline. Right? It is very basic to understand the balance sheet. Okay, what you can expect from this video? The basics of balance sheets, the components of balance sheet, broader outline. What are the various components in the balance sheet? Let us discuss. As per the definition, what should be the balance sheet? The balance sheet is nothing but a snapshot, or it is a what it is called. It's a statement. It shows the financial position of the firm, and it's very crucial for every firm. It should have a healthy finance. Okay, what it shows, the balance sheet reflects the financial position of the firm, right? As per the definition, balance sheet shows the sources from which funds are obtained and where the funds are invested. Means a firm from where the funds it is obtaining means source of funds, and where it is investing means it is what uses of fund. That is nothing but the source of fund is nothing but what liabilities, and uses of fund is nothing but what assets, right? And a company balance sheet should be prepared as per the schedule 3 of Indian Companies Act. This is the most important bit. It may come. Actually, balance sheet has some pro forma, and the pro forma is prepared from which act? That is Companies Act as per Schedule 3, right? And also, I said that it's a snapshot of company's financial position, right? Uh, who uses this balance sheet? Who wants this balance sheet? Okay, and first and foremost things, creditors they want it, lenders they want it, government bodies for what? To regulate the firms and credit rating agencies, also employees and public is for investing in those company, right? That is the balance sheet. Next, oh, what are the components of the balance sheet? From the beginning we have said that we are saying that components of balance sheet, and the actually the left side is called source of fund, and the right side is the right part is called uses of fund. And the source of fund also we call it as a liability, and right side of fund and the use of fund we call it as an assets, right? And the source of fund means a firm is acquiring funds from where? That is called source, right? um, Before discussing all these topics, I will say a small example. Suppose you are an entrepreneur, right? And you are going to establish a factory. Hmm? And you need a fund of rupees 10 lakh rupees. Okay, but you are having only 4 lakhs in your pocket, means that is your saving. Hmm. And you ask to your friends, your relatives, and they said that we will arrange 2 lakh rupees for 8 months. Also, you approach the bank and explain your project, and they are agreed to sanction some loan that is around 4 lakhs rupees. So finally, you pulled around 10 lakhs rupees, right? You are going to start the company and start operations. Hmm. And of the 10 lakh rupees, you purchase 4 lakhs rupees of machinery and plant and machinery, and uh, 3 lakhs rupees your for daily maintaining expenses and all, and remaining 3 lakhs rupees you purchase the raw stock. This whole thing happened to you, right? The first 4 lakhs rupees, from where you got this fund? This is your own fund, means owner's fund, right? Also called it as what? Equity. And the next 2 lakhs rupees you bought it from your friends, unsecured loans these are, and he has given only for 8 months. No, so within 1 year you have to reback this money. This is called current liability. And again 4 lakhs rupees you bought it from bank, right? They have given for 3 years. Let's assume it's a 3 years. This is called term liability. Okay, the 10 lakhs rupees is a total liability of the firm, not you. And one thing you remember, you are separate from your firm. The 10 lakh rupees is the liability of a firm, right? This is called source of fund, or called liabilities. And of this 10 lakhs rupees, you have invested 4 lakhs in machinery. Machinery, this is a fixed asset, right? Machinery is a fixed asset because as long as you run the company, the machinery will exist, or it will be replaced. And again, this 10 lakh, this 3 lakh rupees is for what? For daily expenses, electricity bills, other expenses. And this is what called current asset. And also 3 lakhs is for raw stock. This is also called current asset. Now we will discuss the components. Come to the first slide. Here, the equity. First and foremost, it what? Equity. Equity is nothing but what? Owner's fund, right? Equity is called owner's fund, right? That own money. Second is what? Term liability. Means liability should be repaid within 12 months. I'm sorry, about 12 months. Third one is what? Current liability. Current liability is more what? The liability which shall be repaid within 12 months. And the fixed assets. These assets are the fixed. Means buildings, plant and machinery. Those are current assets. Current asset nothing but what? The assets which will converted into the cash within 12 months. Within 12 months are operating cycle. I will explain in detail in further slides. Non-current assets means it appears like an assets, but these assets will not be converted into the cash within 12 months. And one more thing is called intangible asset. This is also most important. I will discuss it later. Okay. Now, come to the part, equity part. What equity contains? I said equity is nothing but owners of fund and also capital reserves and surplus. What's mean by reserves? Means I said you're establishing a company, right? After 1 year, you got a profit of around 1 lakh rupees. You started with what? 4 lakhs rupees. You started this company. After 1 year, you got 1 lakh profit. Will you keep this money into your pocket? No. A wise businessman will not do it like that. Again, he will reinvest into his firm. Got it? This 1 lakh is again converted into the capital. So this is again become a capital for his firm. So this is called reserves. Got it? And you're running for 2 to 3 years and continuously you're getting profits. The continued profit is called as surplus. The same thing here I have written here. Reserves and surpluses, these are part of equity. What are the subtypes? Capital reserves, security premiums, capital redemption reserves, debenture redemption reserves. The term liability. I said term liability is nothing but it is payable after 12 months. Term is nothing but about 12 months. Like examples, bonds, debentures, next term loans from banks, deferred payment liabilities, deposits from friends or also from others, unsecured loans, next loan guaranteed by promoters. These also comes under term liability. Simple term liability nothing but was the liability which should be payable after 12 months, nothing else. And current liability means now you have to pay. Within 12 months you have to pay. Payable within 12 months is called what? Current liability. Operating cycle is nothing but the period from which raw stock converted into the finished goods is called operating cycle. Suppose next due to settle within 12 months. Simple. You remember one thing, 12 months is a period that is current liability. And also other current, what is other current liability? That is also important. Maturities of long-term debt. Suppose you have taken a loan of rupees 4 lakhs rupees from the bank. Every month you have to pay installment, that is called EMI. Okay, so let's suppose EMI is about 12,000 per month. This 12,000 will be converted as a current liability. This 12,000 will be treated as a current liability. The outstanding amount at the end of the year is considered as a term liability. Got it? Outstanding amount as term liability, and EMI amount is called current liability. Okay. Next, the liabilities portion is over. Equity we explain. Equity is nothing but owner's fund, capital, reserves. Term liability means the liability which should be payable after 12 months. Current liability means the liability which will be payable within 12 months. Now come to the part of assets. Fixed assets. The name itself is a fixed. Means the assets which are fixed, means which are placed in one place, like building, land, building, plant and machinery, equipment, vehicles, furniture and fixtures. Suppose if the firm itself is a furniture business. Consider the firm itself is a furniture business, then furniture cannot be considered as a fixed assets, because their business is supplying the furniture. So furniture will become a raw stock and finished goods in prospect of that firm. Got it? And one more component in the fixed asset we will call depreciation. Depreciation nothing but what? Wear and tear. Suppose you bought a scooter or you bought a car. For around 10 lakhs rupees, you bought it. After 1 year, the value of car will be not 10 lakhs. It will be some other, but below the 10 lakhs, right? Less than 10 lakhs. After 2 years, again it will become the less than 8 lakhs or less than 6 lakhs, depending on the market. So whatever fixed assets is having the depreciation. The depreciation will be compound, but this depreciation tab is under fixed asset, in the balance sheet. Here will be fixed asset, and under fixed asset there will be a component called depreciation. Right? In further videos, I will explain each and everything very clearly. This, as I said, this is my first video, and balance it is a vast, and we can't explain in one video also. And I'm already told that this is the basics of balance. It means in this video we will discuss only components of the balance sheet. Right? Next is what? Current assets. Current asset nothing but the assets which are going to be converted into the cash within 12 months. Just nothing else. Okay, within 12 months the assets converted into the cash, like raw stock. The raw stock will be converted into the finished goods within 12 months. All raw stock is called current assets, like stock, inventory, prepaid expenses, advance tax, advance to suppliers, because all these recovered within 12 months, right? And also current assets is also called gross working capital. This is also most important point. Cash or cash equivalent. Got it? Next is what? Non-current asset. This is most important thing. Non-current asset. They appear like a current assets but not become a cash within 1 year. Like investment in firms, trade debtors. The most important point is unusable stock or dead stock. Actually, this is a loss to the firm, but treated as a non-current assets. And long-term security deposit, like security deposit, electricity board, and etc. While opening the firm, we used to deposit security deposit at electricity board, and it will not be given. It will be at a electricity board only. These are all comes non-current assets. These seems like assets, but these are not recovered within 12 months. And most important point is intangible assets. These assets physically not exist, but it will add some value to your firm. Got it? Physically not exist, but it will add some value to your firm. Like what? Goodwill. Suppose you are entering into the business. You don't know anyone. Anyone don't know you. And Tata is also entering in the same business. Majority people will consider Tata because Tata as having a brand value. Goodwill. That is called goodwill. And brand value, the computer software. Actually, which kind of software you are using, no one will ask. But if you are using advanced technology, definitely it will improve your business and it will add some value to your business. So that is also computer asset. Computer softwares are treated as intangible assets. And mining rights, copyrights, like I also called it was copyrights. preliminary expenses and pre-operative expenses. This is the most important point. This is called as intangible assets. Accumulated losses, this I will discuss later. Accumulated losses is the most important one. Accumulated loss will be treated as intangible asset. Got it? So until now, assets will be also over. What you have discussed: fixed assets like building, machinery, inventory. Current assets within 12 months. Non-current assets seems like a asset, but about 12 months, or we cannot say the time also. Intangible assets seems like a assets and physically not exist, but add a value to your firm. Right? There is one more point is called footnote, also called footnote. It will be under liability tab, also called as footnote. This value will not be considered while calculating balance sheet. But this is also most important, called contingent liability. What is maybe contingent? Contingent nothing but suddenly happen or accidentally happen. That is what contingent, right? So if something happened to that firm, from where the funds will be bought, from contingent liabilities, like guarantees given. Suppose promoter has given the guarantee to some other company, and that become NPA. Who will bear the expenses? That expenses will by your that promoter. Also, suit filed against any firm, bills endorsed. These are all called contingent liability. This is also called footnote. Means it exists under the tab of liability, but will not be considered while calculating the balance sheet. Okay. Till now we have discussed all the components of what balance sheet, right? Um, like what liabilities, what are the liabilities, and what are the assets. These are the basic component of the balance sheet. And further videos we can discuss about the ratio analysis based on the balance sheet, and what a credit officer should do, and what components should be important for a credit officer, and also fund flow analysis, income sheet analysis, and other basic concept we will discuss in further videos. And one more request, as this is my first video, if you like my content, kindly subscribe to my YouTube channel, Finbank Academy. Thank you all.